This is our lecture 17 of financial management, and we are going to continue our discussion on the chapter of bond valuation. So previously we have seen the valuation of a coupon and zero coupon bond, and we had discussed their examples. Now in this lecture we are going to understand the valuation of perpetual bond. Then we are going to discuss the discount and premium bond, and then we would have a discussion on nominal and real interest rate, and we will try to complete this bond valuation chapter in this lecture. So starting with valuation of a perpetual bond. Now this concept, this perpetual bond, is related to what we discussed in time value of money. In time value of money we had the concept of perpetuity. Now there was another concept that we also discussed along with perpetuity in time value of money, that was called annuity. Now what was annuity? Annuity was when we had a fixed amount of cash flow and for a finite time period. So for example, we are going to receive 100 rupees for each year for 3 years. So the 100 rupees is fixed, the amount is fixed, and the time period is finite. We know the time period in advance. So that was annuity, and perpetuity was when we are going to receive or pay, and there is a cash flow, the cash flow amount is fixed. This is the similarity between annuity and perpetuity. In both annuity and perpetuity, the amount is fixed, the cash flow is fixed. The difference between annuity and perpetuity is that in annuity we know the time period for how long the cash flow would occur. The cash flows, the time period is finite, but in case of perpetuity, time is infinite. So for example, we are going to receive a cash flow forever, for infinite time period. So when that is the case, and if we have a bond where there is a perpetuity, that bond never matures. If a bond never matures, then that bond is called perpetual bond, and it is also called console. Okay, so now once we have understood the perpetual bond, the bond that never matures, say State Bank of Pakistan issues a bond and that bond would never mature, that would be an example of perpetual bond. So the value of perpetual bond would simply be equal to the present value of infinite stream of interest payment. Now if you remember the formula for the calculation of present value of perpetuity, then that was C divided by R. This formula was used to find the present value of perpetuity. So similarly, in case of a perpetual bond, we can find the bond value, the intrinsic value of this perpetual bond by using the same concept. We have C divided by R, where C is the fixed interest payment that we are going to receive. It is a bond, so bond pays us a fixed interest payment, and this fixed interest payment would be C. So for example, we are going to receive 100 rupees per year for infinite time period, so that 10 years is the fixed interest payment, and that would be RC, and this R would be the yield to the interest rate. Okay, so suppose you could buy a bond that paid $50 a year forever. So once we encounter this term of forever or for infinite time period, then we immediately know that it is a perpetual bond. So if you could buy a bond that paid 50 per year, so what is this 50? This is C in our formula. The required rate of return for this type of bond is 12%. This is R. At what value should you buy this bond? So this would be 50 divided by 0.12. And this would give us a value of 419. So if you wanted to buy this bond, we would buy it at 419 rupees. So this marks the end of our understanding of our discussion of the valuation concepts. We had completed the discussion on valuation of a coupon bond, valuation of a zero coupon bond, and then we discussed in this lecture the valuation of perpetual bond. Now we would move towards the concept of a discount and premium. We have discussed some idea of discount and premium. We would look into detail of it. So this is the table that I have copied from our reference book, which is the Principle of Managerial Finance by Gitman. It says that when coupon rate is equal to yield to maturity, the price of the bond would be equal to face value. And we would call it that this bond sells on or at par value, or this bond trades at par value. Now if we move backwards to one of the examples that we had, so this is the example that we discussed in one of the lectures where we valued this in the discussion of valuation of a coupon bond. We had this example. Suppose the ABC company were to issue a bond with 10 years to maturity. The bond has an annual coupon of $80. Similar bond have a yield to maturity of 8%. If face value of this bond is 1,000, what this bond would sell for? Now first thing, we know the yield to maturity, but what is the coupon rate in this case? The bond annual coupon is 80, and we can find the coupon rate by dividing this 80 on the face value. So this would give us 0.08 or 8%. This is the coupon rate. You would notice this coupon rate is exactly equal to yield to maturity. So when the coupon rate is equal to yield to maturity, we would say that this bond sells at the par value. And the par value is another name for face value. So we can also say that this bond sells at the face value. And what is the face value? Which is 1,000. So in this kind of an example where the yield to maturity is equal to the coupon rate, both are annual or same frequency, then we do not need to calculate the intrinsic value. The intrinsic value would always be equal to the face value, right? And this is what we saw in this slide. The coupon rate was 8%, yield to maturity was 8%. We saw that it would sell at par value. And if you go back to the slides of or video of the valuation of coupon bond, and you find the answer that we had in that example, we calculated the answer for that example, you would know that we calculated the intrinsic value of 1,000, which is equal to the face value. Now, what would happen if coupon rate is lesser than yield to maturity? If coupon rate is lesser than yield to maturity, we would say that that bond would sell for lesser than face value, right? We would immediately know if coupon rate is lesser than yield to maturity, the bond's price, the intrinsic value should be less than the face value, and we would say that this bond is a discount bond and sells at a discount value. In another case, when the coupon rate is higher than yield to maturity, we would say that that bond sell at premium. and its value would be greater than the face value. So let's have an example. Now consider 30 years bond. There are 3 bonds, they all matures in 30 years with an annual coupon. One bond has a coupon of 10%, the another one 5%, and the last one is for 3%. If the yield to maturity of each bond is 5%, what is the price of each bond? What is the price of each bonds per $100 face? If the face value is $100, then we need to find the intrinsic value. So, quickly looking at comparing the coupon rate and the yield to maturity, we can immediately know that this second bond that have a coupon rate 5% is equal to the yield to maturity. We know that this specific bond would sell at $100. The intrinsic value would be $100. We do not need to calculate it. For this bond have a coupon rate higher than the yield to maturity. This should sell at a premium. This would be a premium bond. Its intrinsic value would be higher than the face value. This bond have a coupon rate of 3%, lesser than yield to maturity. We know that its intrinsic value should be higher than the face value. So I am not going to solve this question, but what I would recommend is that you find the intrinsic value of all these 3 bonds. First find the intrinsic value of 10% coupon bond, then find the intrinsic value of the 5% and then 3%, and just see whether what we just discussed in the previous slide in the table of the discount and premium, see whether that understanding holds or not. So next we discuss the interest rate risk. And what is interest rate risk? It is the risk that the bond price may change due to change in the interest rate. So the value of the bond would fluctuate with the change in interest rate. So this is what we call the interest rate risk. So there is a inverse relationship between the value of the bond and the interest rate. So when the interest rate increases, this is the bond value, when interest rate increases, the bond value decreases. So at this specific interest rate, bond value was higher, but as the interest rate increased in the market, the bond value decreased. So there is an inverse relationship between the bond value and interest rate. So with the rise in interest rate, the present value of the bond decreases. So suppose that ABC, this is what we already discussed, suppose the ABC company were to issue a bond with the face value of 1000 with 10 years of maturity. The bond had an annual coupon of 80, similar bond had a yield to maturity of 8%. What would this bond sell for? And we already know, we are already discussed, we are already found its intrinsic value, and that was $1,000. Okay, now what would happen if the interest rate changed? So if the interest rate in the market increased to 10%, previously it was 8%, now it had increased to 10%, but will be the value of the bond, the intrinsic value of the bond, it would decrease. It would now be 876. I have already calculated it. You can calculate it using the bond valuation, coupon bond valuation formula. You can take the yield to maturity as 10%, and the rest of the data is given in the previous slide. So what if the interest rate in the market dropped to 6%? So instead of increasing, it dropped from 8% to 6%. What will be the bond value? Now it would increase. So this is just to demonstrate that there is an inverse relationship between the bond price and the interest rate. So, okay, and we have already seen the discount bond and the premium bond. Now, what this interest rate risk depend on? So the interest rate risk arises from the fluctuation in interest rate. This is what we have already discussed, but it depends on two aspects. One is the maturity of the bond and then the coupon rate. So which bond would have higher risk? Would a bond with a longer maturity or a bond with a shorter maturity? So first thing, the longer the times of maturity, the greater the interest rate risk is. So one aspect of interest rate risk is that bonds that have a longer maturity, the expiration is longer, the maturity is longer, they are long-term bonds, they would have higher risk as compared to the short-term bonds. So why is that so? Now if you know that the bond valuation depends, a coupon bond valuation depends on two aspects, the coupon and then the face value. So if you remember the coupon bond valuation formula, we had two aspects. We find the present value of the coupon that we receive, and then we find the present value of the face value that we would receive at the end of the maturity. So when the maturity is longer, this face value would be highly affected by a smaller change in interest rate. So when the interest rate changes, say the interest rate increases, it would have a higher impact on this face value. So if face value was 1000, imagine the interest rate was previously 8% and now it increased to 10%, right? How would this be as compared to, say, this example? If the bond is of a maturity of, say, 3 years. So first you find the present value of the face value if the interest rate was 8%, 0.08, and then you compare it, this value, the present value from this formula, you compare it with this one, and you would see that as compared to shorter maturity bond, the longer maturity bond would have a higher decrease in price. The second aspect of interest rate is that the lower the coupon rate, the greater the interest rate risk is. And that is because, again, the understanding is in this face value, because so in case of a lower coupon bond, the smaller aspect of this bond would be received in the coupon and a major chunk would be received as the face value, whereas in case of a higher coupon rate bond, the comparatively a larger chunk would be received in the early years, where the face value would be comparatively lesser. So a change would again have a higher impact on those cash flows that would be received at the later time period. So let's discuss this with the help of this graph. You can see that this green line represents a bond with 30 years of maturity, and this blue line represents the bond with a 1 year maturity. And you can see that when the interest rate was 5%, this 30-year bond had an intrinsic value of 1700, and when the interest rate, say, increased to 20%, then its value decreased. We know that when the interest rate increases, the value of the bond decreases. The value of the bond of this 30-year bond decreased to 500 rupees or dollars. So the slope is higher. When the slope is higher, the rate of change is higher, the risk is higher. And now compare it with this blue line, which is a 1 year bond. And you would see that this bond had an intrinsic value of 1000 when the interest rate was 5%, and when the interest rate increased to 20%, there was a decrease in the price, but the decrease was quite small as compared to a longer maturity bond. So a longer maturity bond decreased by almost $1,200, whereas the short-term bond decreased by merely around $100. So that shows us that the change in interest would have a higher impact on a long-term maturity bond as compared to a short-term maturity bond. So the risk is higher in the long-term maturity bond. So this is our last concept of this chapter, which is the real and nominal interest rate. Now, what is the real interest rate? The interest rate that is quoted. So when you go to the bank and ask for the interest rate that they tell you is the nominal interest rate. We can also define this as the interest rate that is not adjusted for inflation. And they are always quoted, interest rates are always quoted as nominal rates. I have just said this. So what is a real interest rate? The real interest rate is the interest rate that is adjusted for inflation. So for example, you get an interest of 10% on your deposit from a bank account. So that means if you deposited 1000 rupees, after 1 year this 1000 would be equal to 1100 rupees. Now consider inflation. During this 1 year, the inflation was 5%. What this means is that the general prices of commodities increased by 5%. So what if there was an asset that you wanted to purchase at the start of the year, which had a price of 1000. So after 1 year, its price would now be 1050. So although during this time period, your investment rose to 1100 rupees, you earned a 10%, but also there was an increase in inflation in the prices of the commodity. So in real sense, you didn't earn 10%, you earned 10 minus, or approximately 10 minus 5%. So this 10% is the nominal interest rate. It is not adjusted for inflation, but once we adjust it for inflation, we deduct from it the effect of inflation. Then what we get is the real interest rate. So real interest rate is adjusted for inflation. By adjusted, we mean we have deducted the effect of inflation from the nominal interest rate. So basically, although you have earned 100 rupees, but your purchasing power didn't increase by 100 rupees, it's merely increased by 50 rupees. Because the 50 rupees from this 100 rupees would go towards the inflation. I hope you get the idea. So then there is a Fisher effect, and this Fisher effect explains that describes the relationship between the real and inflation, and it explains that the real interest rate falls as the inflation increases and vice versa. And we have seen as the inflation increases, say instead of 5%, inflation was 7%. Now when you would adjust it, you would get the value of 3%, which this statement explains is that the real interest rate would fall as the inflation would increase. Let's have an example, but before that, let's have a look at the formula of Fisher effect. Remember, Fisher effect describes the relationship between the nominal interest and the real interest. So it says that the nominal interest is equal to 1 plus real interest rate into 1 plus inflation. This capital R stands for nominal interest rate and this small r stands for real interest rate, H for inflation. So example, if an investor required a 10% real interest rate, right, so this would be 0.10 into 1 plus, and the inflation was 8%, so inflation is 8%. What must be the nominal interest rate? So the question is that if an investor wanted to earn a real interest rate of 10% and the inflation was 8% in the market, then what nominal interest rate he should earn, that after adjusting for inflation, he should get 10%. So if we write the equation, it would be again 1 plus R is equal to 1.188. So if we transfer this 1 to the right side of the equation, this would be minus 1, and we would get is R is equal to 0.18 or 18%. So what this 18% means is that if you want to earn a real interest rate of 10%, then you should deposit your investment in an account where you at least get a nominal interest rate of 18%. So there is a second example. If a treasury bill are currently paying 8%, this is nominal, and the inflation rate is 6%, what is the approximately real interest rate? So now in this case, you do not need to find the nominal interest rate. The nominal is already given, it is 8%. You would just use exactly same formula, but instead of finding this aspect, you need to find this part of the formula, right? So you can algebraically do it. There is another example. If the nominal interest rate is 15% and the inflation is 5%, what is again you need to find the real interest rate. So you can solve these questions by trying them. And what I would recommend is that from our textbook, which is the Fundamental of Corporate Finance by Ross, try the question number 3 to 11 from the bond valuation chapter.